In April 1991, the Indian stock market index, the Sensex, sat at roughly 1,200 points. Exactly 1 year later, it hit 4,500. The market quadrupled in 12 months. The man driving this surge was a stockbroker named Harshad Mehta. He earned the nickname the Big Bull, operating from a 15,000-square-foot penthouse and driving India's first imported Lexus. But the math behind his rise didn't add up. Corporate profits hadn't spiked, and retail investors didn't have the capital to push the market this high. Mehta was injecting massive amounts of ghost money into the exchange, and no one knew where it was coming from. Mehta's performance was rooted in a structural flaw he discovered within the interbank transfer system, a gap that allowed him to move capital with virtually no oversight. To understand how a leak this large went unnoticed, look at the financial infrastructure of early 1990s Mumbai. This was an entirely analog world. Trade was conducted on paper, carried in briefcases, and recorded in physical ledgers. Today, algorithms execute trades in milliseconds. Back then, brokers stood in a physical trading ring and shouted orders over each other. If a bank needed to transfer assets, they didn't click a button. They hired couriers to drive paper documents across the city. Because there was no digital network to instantly verify who owned what, the entire financial sector ran on a system of physical handoffs and implicit trust between institutions. Relying entirely on good faith paper trails created a massive vulnerability. It left a multi-billion-dollar blind spot wide open for anyone willing to exploit it. The exploit started inside the interbank money market. The Reserve Bank of India required banks to maintain a specific ratio of cash and government securities. To meet these daily quotas, banks constantly issued short-term loans to one another. These 15-day loans were called ready forward deals. If Bank A needed liquidity, Bank B would lend them the cash. In exchange, Bank A would temporarily mortgage its secure government bonds to Bank B as collateral. But physically moving highly secure government bonds via armored car for a 2-week loan was a logistical nightmare. The banks needed a shortcut. Instead of transferring the actual bonds, the borrowing bank would issue a piece of paper called a bank receipt, or BR. This was a legally binding ILU. It was a promise that the borrowing bank held the actual government securities safely in their vault. The banking system had taken highly secure, federally backed assets and replaced them with pieces of paper that anyone could print. Banks rarely dealt with each other directly. They hired money market brokers to find the best lending rates and facilitate the exchange. Harshad Mehta became the go-to middleman for these transactions. Mehta noticed a procedural error in how the banks handled the money. The lending bank would transfer the loan cash directly into his personal broker account before the deal was finalized. This gave him a window of up to 15 days to find a borrowing bank and deliver their BR. He called this window the float. While the cash sat temporarily unassigned, Mehta pumped those millions into his favorite companies, artificially driving up their stock prices through sheer volume. Once the stock price surged, he sold his shares. He pocketed the massive profit and forwarded the original loan to close the money market deal. By hijacking this delay, Mehta gambled with billions of rupees in bank funds at zero risk. He turned public deposits into his private bankroll. Eventually, the 15-day float wasn't long enough. To keep his chosen stock prices artificially inflated, Mehta needed a permanent massive cash injection so the market wouldn't correct itself. He crossed the line into outright fraud. Mehta bribed officials at small institutions, like the Bank of Karad, to print fake bank receipts. These receipts claimed to be backed by government bonds, but the vaults behind them had zero government securities. He handed these worthless paper IOUs to major lending banks. In return, they transferred billions in real cash into his accounts, which he dumped directly into the stock market. By weaponizing the banking system's blind trust, Mehta had built a machine that printed infinite money. In late 1991, the Reserve Bank of India noticed anomalies and began investigating the rampant misuse of bank receipts. They issued strict new guidelines, making it very difficult for Mehta to pass his fake paper. Desperate to maintain his stock prices, Mehta illegally extracted a 500 crore rupee loan directly from the State Bank of India. He didn't even provide a fake BR this time. Instead, he bribed an inside employee to manipulate the bank's ledger and hide the massive gap in their records. The cover-up failed. Journalist Sucheta Dalal discovered the missing funds and published a front-page exposé in the Times of India in April 1992. The exposure triggered a nationwide panic. The investigation reached the highest levels of the Indian government, with Parliament demanding answers for the missing funds. A single newspaper article popped the illusion of infinite liquidity, and the artificial market crashed immediately. The audits revealed a 4,000 crore rupee hole in the banking system. Stock prices plummeted, wiping out the life savings of thousands of retail investors. Harshad Mehta was arrested shortly after. Investigators quickly realized the crisis was the inevitable result of an archaic, paper-based banking system that relied entirely on manual verification. To prevent another systemic failure, the government established the National Stock Exchange. They built a fully electronic, transparent trading environment where transactions are monitored in real time, removing the blind spots that allowed the fraud to occur. The 1992 scandal showed the limitations of a trust-based system, acting as the catalyst for the technological overhaul of India's financial markets.